Hello everyone. If you want to go to my free course, type henry-ward.co.uk into Google, then go to Henry Ward Trading, and then this here is my free course. Click on Start Today. If you want to go on to the webinars that I do every Sunday and every Wednesday, click on Trading Academy and then click on Start Today. So this is the Trading Academy. This is the full training, the webinars, direct access to me, everything that you want. We'll start off here with the NASDAQ. So we've been looking at this and wanted to go up, hit its head, come back down, and then take off. Now, what's ever happened? It went up, hit its head, come back down to here. We took it along, it's gone back up, and it's broken this high. Now, obviously, this is unbelievably optimistic. This is unbelievably optimistic. Now, the market has made higher highs, which is brilliant. That's exactly what we want. The next question is we've had a wick down, we've had a doji bar, and forget about today's bar. I know it's only a little red bar, but it hasn't started. So we'll get rid of today's bar so it doesn't give us any sort of insinuate what's going to happen. Now, what do we expect to happen next? Just looking at these price action bars, what are they telling us? These price action bars that we're seeing right here, what are they telling us? Because remember, price action tells us a pretty important story when we're trading. What story are you seeing here? Andrew said a market slowdown. Shane says due for a drop. Anyone else see anything differently? Anyone else see anything differently? And the answer to that is I don't see anything different than what you guys have said here. Yes, we have a bullish day. Yes, we had a wick down to the bottom, but we had a big bullish day. Yes, we have a wick coming down, but we only have a small bullish day here. Again, we've had wick coming down. It went back up, and then the seller started pushing it down again. So there's a bit of a fight going on here between the buyers and the sellers at the moment. So just get rid of that. So it's not, as we can see, there's an argument going on here between the buyers and the sellers. So if we look in this into a little more detail. So we have that bar there. Now, can everyone tell me what that bar is called? What's the name of that bar? What's it called? High test bar? Nope. Doji bar? Indecision bar, Kathy, that's correct, but that's not the name of it. Doji, so it's a doji bar. Okay, so a doji bar is a bar that the open and the close is in the middle of the bar. Okay, so that's what we have there. The open and the close is in the middle of the bar, which means we have a big wick at the top, a big wick at the bottom, and nothing in between. So that's a doji bar. Can everyone tell me what this bar here is? Hammer, low test, hammer, low tests. Absolutely well done, guys. Yes, that is a low test bar or a hammer. Absolutely. Now, those two bars give us two different scenarios. Okay, so this bar here tells us that the market could go up or the market could go down. That's why it's called an indecision bar. This bar here that we saw there, that gives us an indication that there are more buyers in the market than sellers. But in this particular scenario, we have to look where we're at. And at this particular point, from there to there, so from this to there, we are early. We're early in this stage. Anything above this section is late. Okay, so do we trust a bar like this that I said it was going down, comes back up, and going to continue going up? No, not at all. Not really. Why? Because we are overextended. We have this doji bar here. So now we're looking at the wick on this. Rather than look where the body closed, we're looking at the wick. So look, there was actually sellers trying to push this down. The sellers were trying to push this down here. We now have the next bar, whereas the buyers are not as bullish as this one. The sellers and the buyers were about 50%, whereas in this one, there was about 70, 80% buyers. This bar, there's a little bit less. So we would expect the market to actually have a drop by looking at this price action, this formation. Now, also what we're going to do is we're going to add in that high here. Theoretically, we would have expected a bounce off this level over here. But yes, we've had a break to the higher high. But can anyone tell me why the market may have pushed a little bit higher there? So there's two scenarios why that market has pushed a little bit higher. Can anyone tell me the two scenarios? Well, can anyone tell me the two scenarios why that there may have pushed a little bit higher? Good earnings. Okay, so what's that called? We can't just call it good earnings. We're going to wrap that in something. So we're going to wrap the earnings in something. So what are we wrapping it in? Remember, go back to basics, very, very basics. Perfect. Trend. Well done, Wayne. So we're going to wrap earnings in trend. So the trend is going up. And can anyone tell me a little more sinister reason why this may have made a higher high? A bull trap or stop loss hunting? Okay, so there will be people who have jumped in here as a short on this particular bar here. There will be people who have jumped in here and they would have had their stop loss either at the top of that bar or the top of this one. So which means the market has pushed up a little bit higher, triggered all those stop losses, and then continued. Or the other side is that it pushes up, triggers all the take profit on people. Because how many people, so anyone listen to me, taking this, we would have had our take profit inside there. Anything more, anything higher than that there, you're in bonus territory. So our take profit is just inside that there. So anything more than that, you're in bonus territory, and theoretically we shouldn't be in the game because that's where we'd expect the market to change. So what would happen is the buyers push it up, trigger all everyone's take profits, which means that the buying power now is halved, which means then there's more selling power once they come in. So once they take a short position, that then the retail traders will jump in. So if it drops down here, the retail traders are looking for confirmation, and then the retail traders will jump in somewhere around here. Even though we've had a big proportion of this move already. Now this may only be a phase 2. So it may only come back to here, and then it turns back around to the upside. Or this may continue and drop down the whole way down to this double bottom down here. They're the two scenarios. But this here would be classed as sort of stop loss hunting for the short positions, triggering out all the longs on their take profits. Then at this particular point, we could actually see a big sell-off to the downside. So there are the two reasons for me why we'd expect this to go a little bit higher, which it did, and then pop down to the downside. Quite similar to what has happened there. I'm going to remove that. Quite similar to what happens here. Made a higher high, and then it dropped like a stone. I understand they're slightly different markets or different times. But similarly to that one. So it's made slightly higher high, triggered out everyone's take profits. Anyone who had a short there as well, you would have been triggered in on the way down here, then triggered out. And then this looks now like it's going to continue going down. So that was the long position there, wasn't it? I moved it over to there. So theoretically, anyone who was in this long should be out around there. Now, the question is do we expect this to delete? So do we expect this now to come down to here, then pop back up? Or are we expecting this to pop down to here? So this is A and this is B. Which of the two do you think is the most realistic? Which of the two do you think is more realistic? I said A, B. A if earnings is good, B if they're bad. But we're actually seeing some good earnings across the board. We're seeing a little bit of strong earnings across. So what happens if earnings are pretty decent? So we have 50% of the market is good and 50% of the market earnings are bad. Now, for me, whether the earnings are good or bad, I expect this to hit this point at some point. I expect it to come down to here at some point again. I don't expect this to be all rosy and take off like we did in the pandemic. I don't expect that. I don't expect this type of recovery. I expect this type of recovery. So market dropped down to here. This particular scenario, it dropped 13%. And then it come back down and almost double bottom, even after it made a higher high. Look, it made a higher high and then double bottomed Then it took off, made another higher high. And look, the market actually made a lower low. And in this particular scenario, the market dropped 24%. It went up, made a higher high. And then we had a drop again. Obviously not as big or severe as this one. And a higher high, and then we dropped again. Came down, almost double bottomed again on this one. And then we actually had a take off. And then we had the pandemic drop. And then this one has never come back. Okay, so looking at historically, I would probably expect it to come back at this particular point at some point. Do I think this is the beginning of the recovery? Yes, I do, but it still may go down another 10%. But I don't expect it to drop much more than that, because there's a little bit of buying power at the minute. People are starting to look at this as going, oh, this could be the beginning. This could be the beginning. So am I putting all my eggs into this basket at the minute? Absolutely not. But what I have done is I have bought up of the 5 or 10 companies that I think are good and sustainable and be here for the next 10 years. I have bought them up. I have done a round of shopping. Am I trading this at the present moment? Not really. Not really. Am I looking for clear 3-to-1 winners? As you can see here, not. I'm getting in a nice clean areas and putting my take profit exactly where in front of support and resistance. So where we should be out of the market. But remember, they're the two scenarios that we're sort of looking at to happen in over the next, say, month. Now, ideal scenario is that next month we're up here. We're talking about it up here. And then the pullback only come back down as far as here. That would be the ideal scenario. But again, since when has trading ever been ideal for us? Never. The idea is to try and navigate it and then work out where the key areas to get in. So just on that, has anyone got any alternative ideas to that? I'd be interested to hear. Has anyone got any alternative to this dropping down here? Or this hitting here and bouncing up? Does anyone think that this is going to continue dropping and drop another 20 to 30%? Is there anyone here that thinks that we're going to have a global recession and it's going to continue dropping another 20 or 30%? So Carol says, yep, you expect another 20 or 30%. Okay. I don't expect it to drop that far. I think with the Fed managing the way they're trying to manage it, I think we will have a recession, but I think it shouldn't hit the stock market as much as it has done historically. Because historically, winter is coming. Are you north of the wall? So historically, when we get a recession, we're getting the recession up here, aren't we? Whereas we've already dropped 30% before we even get that recession. So theoretically, we've already had a drop in the market. The market is the stocks have already depreciated. And it's just a question mark of how much more are we expecting it. Now, the good news is if it drops down to 50%, which with your prediction dropping down to 50%, that's the brilliant opportunity to start buying up again. buying up your favorite stocks. Now, I don't mean the lemonades of the world. I don't mean the Palantirs. So let's have a quick look at them. It's a PLTR. I'm in indices. I'm going to turn on the stocks. That would probably help. And I'm not talking about the likes of the Palantirs of the world. I'm not talking about the likes of these. What is a utility? The likes of the lemonades. I'm not talking about jumping into the likes of these stocks. Let's have a quick look at Coinbase. Again, I'm not talking about the likes of these stocks. I'm talking about stuff that has continuously done well. I'm talking about the likes of, say, Apple. I know I've come and I've said Apple before, but look at, say, for instance, Apple here. So since 2019, it has had no bad earnings. Zero. Let's have a look at the Microsofts. Microsoft has had one bad earning since 2019. McDonald's. Okay, nope, we skipped that one. Nvidia. Nope, again, zero. Let's have a look at Berkshire Hathaway. Yes, it has had a few bad ones. EW has a couple, so I would sort of steer clear of that one as well. Accenture, 2. And this one had bad earnings, but their revenue was up by 0.75%. So that sort of wiped that one out. And this one was just a bad one across the board. Likes of Enphase, 1. So we're adding really good companies. Now, I know I'm just looking at earnings, and now earnings is always a sort of a decent metric to find out whether a company is doing well or not. It's a very simple one to look at, isn't it? And that's a way of looking at, stocks that just have really, really good potential. Really good potential over a long period of time. That even when the markets are dropping, that these guys still have some upside. These guys still have the potential to do what they're supposed to be doing. Now, also, what we could be doing is putting in the likes of say MasterCards and Visas. Again, one bad earning through this period of time. Now, again, it hasn't really moved anywhere in the last couple of months since October. Last year, it hasn't really gone anywhere. But with money getting more expensive, do we think this is good for the likes of credit cards or bad? Again, look, one bad earnings in this period. Is this the MX one? Nope, it's not. But do we think it's good or bad for the likes of do we think it's good or bad for the likes of these credit card companies? Well, in a sense, it's not going to be bad for them. Why? Because people will have to borrow money, which means people will shop around. And if interest going up, yes, it is harder to borrow money, but it means that the revenue the likes of these companies are going to make is actually higher. Look at the scenario with energy companies. So energy companies' revenue has jumped 5 times in the last year. 5 times the expected earnings. Why? Because the demand on it, they're not passing on the savings. Anytime oil goes up or down, you're just paying the highest price for it. So they're keeping all that. So the same with the likes of these. They're not companies that are going to pass on massive savings onto customers because they want profits over anything. Other ones, Coca-Cola. Two bad earnings. And these are companies that will slowly make you money. So they're the kind of things that we if you're looking to buy up, in my opinion, that's the kind of stuff that we should be looking to buy. I'm not looking to buy stuff that just is out of the middle of nowhere. I'm not just looking to buy stuff that I've never heard of before. I'm not looking to buy stuff that is the likes of the things that IPO'd last year or the year before. Why? Because they generally don't hold their own. They generally drop. A lot of them are down below where they were previously. Let's have a quick look at Uber. So Uber had a great run here. And look at this momentum. Bad earnings, bad earnings, bad earnings, bad earnings. And then look, it had 2 good earnings because of this period here of people using everything. And then look, it's now continued to drop. And because of the earnings here, I probably expect that to continue dropping. But I don't see any reason why this should pop to the upside. It's competitor Lyft. You jumped in and Lyft in its IPO, where you are now. Even though, look, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, even though they've had 12 good earnings. Even though its intrinsic value is probably higher than this price. And the intrinsic value, for anyone who doesn't know that, intrinsic value is the actual real value of a company. So the idea is if you got the company and you just sold everything in the company right now, today, what the actual amount of money that you would make, whether you're in the loss or whether you're in the plus. So that's what the intrinsic value means, is how much the company is really worth, not what the stock price is worth. So they're the things that we're looking at. Let's have a quick look at Peloton. I know that was the big darling child for a little while. People jumped in on that massively. I know some of you guys followed Jay Nemesis, and he was in this quite heavily. We're now back down below the IPO price. We had a couple of good earnings here, and then all of a sudden it continued to drop. But do we, Kashi, I'm assuming you still have it by that reaction. But do we expect Peloton to pop back up? Probably. They will start selling new products. They will start doing new things, new clients. It will start going into gyms, stuff like that there. So yes. Okay, so we only traded last year as a CFD. Okay, good. But again, that's there is how common is that with what has happened over the last 3 or 4 years? Something IPO'd, it took off, pandemic, absolutely carried on going, had that big drop down, carried on going, and then all of a sudden it's dropped like a stone. Why? Because we've come out of the pandemic, people have stopped using these streaming services, and earnings have dropped off a cliff. And they're missing their earnings by not by 1 or 2%, by huge amounts. By huge amounts. So that's the difference between, that's the difference in what I'm investing in at the minute and what we're looking at in the market. Now, when everything is going all well, we jump on these, and these are huge growth stocks. These ones, the likes of these will, once they take off, they will run like crazy. They will do you 200-300%. So the idea is we need to have our take profit on the likes of these. We have to, whenever there's a pandemic, whenever there's a recession, whenever there's something like that globally or historically bad for the likes of these companies, we need to be jumping out of these. Whereas the likes of the staples that I've gone through, the likes of the Apples, the Microsoft, the Nvidias, the Accentures, the Coca-Colas, the likes of the Nikes of this world, they generally continue. The likes of, I think there's also Home Depot, and what's the big American store? Walmart. They're the kind of companies that just continue hitting revenue targets over and over again. So at the minute, slow and steady wins the race. We're not looking for these big growth stocks at the moment. Slow and steady wins the race. So let's have a look at the rest of the indices. So the S&P is very similar. Is very similar to the likes of the NASDAQ. Now on the NASDAQ, for me, there's no short position. This why? Because we made a higher high. We've broken that level. So there's no short position on the NASDAQ. But if we drop down to the S&P, there is one. So if we look at this here, we have 1, 2, 3, 4, 5 bounces. It's now had it hit its head. It's also had an inside bar. So this is a huge reversal pattern. It's hit its head, inside bar. I would expect some sort of a sell-off. Now the problem is how far do we go down on this? How far do we go down? And the idea is we have to put ourselves in a safe place, and that there is where the next high is. So for me, if I'm shorting this, I am only looking for a 1-to-1 on this. And then what I would do is if it gets close to my 1-to-1, start trailing my stop loss, put it inside break even, and then sort of go from there. Okay, so that's the idea, is sort of trail these. The Dow for me, it's not at that level, so it's not hitting it. So if anyone's looking to short, the S&P is the one that we'll be looking to short. If you think there's more momentum to the downside, that's where we're looking to trade. With the Dow, there's no trade short there at the moment. Same as the S&P. Yes, we have an inside bar. Absolutely looks great, but not for me at the moment. German DAX, again, we've had a couple of days to the upside, and now we've had sort of 2 selling off days. It has come back to that level, but again, it's not, the cyclicity is not clean enough. If we look at this, 1, 2, 3, 4, 5 bars moving sideways. Are we going to have 5 bars moving sideways? Is it going to come back down to that level there? Which I would sort of expect it to do, at least come back down to here. If not, even come back down to into this level here. French CAC. Again, there's no level there. It's after breaking through this sort of blue level. So, but there's not a huge sell-off there indicated. We just have had buying power across this. It's not like the German DAX where we've had a little bit of phase 2, phase 1. We can actually understand the pattern. With the French CAC, we've just had a spike to the upside. UK 100, again, would have liked it to hit this ceiling here, and then we could have actually shorted that. But the idea would be for this to come back down to that level, and there's a potential buy at that level. So you'd expect it to, if it gives us a nice price action, we'd be looking at that as a buy at that particular point. So we talked about this big, huge red bar here, bouncing off this floor and then potentially going up, and it just continued coming down. So anyone who took that there didn't trigger you in, which is, that's the kind of trades that we like to take that we're wrong with. But again, I anticipated this coming back down to here, and it looks exactly like it's going to happen. It looks like there's nothing going to stop it before then. I'll leave that because it might break and retest it and then drop again. So I don't see any reason for that stopping before that floor there. So I know some of you guys were looking at this as a buy here at that particular point. Again, it wasn't something that jumped out at me at all. Ideally, you would have had your stop loss behind here if you had taken it as a long. And it looks like yesterday you would have been triggered out if you'd have taken that as a long. Some of you potentially may have taken that as a short on that high test bar there, which for me would probably have been a better trade. But what's the negative about taking that short? What's the negative things about taking that short? What's the things we have to be aware of? If we're taking that to the downside, what are the things that we have to be aware of? These are the things we have to be aware of. Okay, that we have that level there, but we also have this level. So we have levels there. So we have to break these levels for this to continue going down. Now, with what's gone on here, when it's come down into this area, this is sort of a buying zone. So when it's come down into this buying zone, it seems to bounce to the upside every time it comes into this buying zone. So am I confident that's going to continue going down? No. For me to trade this is what has to happen. It has to break, retest, and then I'll take it short. So it has to break and retest, and then we'll look to take it short. That's the only position for me to be taking a short. Other than that, this is sort of no man's land. It's in this sort of zone, this area where it seems to continue bouncing. Is there not an obvious take profit? Wayne, I missed that question there. Is that to do with oil here? Or what was that question in relation to? Well, if we're looking at oil as a short here, okay, my explanation answers. So if I was looking for a short here, you would never be looking to short into this. It has to break and retest, and then we'd look to take a short. As in a buy, the buy that was here, again, I would never take it. Why? Because we have this huge sort of trend line here that's bounced once, twice, 3 times, 4 times. And look, it's actually bounced 5 times. Yes, it'll eventually break one of these. It'll eventually break one of them. And at the minute, it looks like it's going to break this horizontal rather than the trend line. But bear in mind, horizontals are stronger than trend lines. Natural gas. So we actually had a huge rejection there on natural gas, which I wasn't expecting a rejection that big. I was expecting a rejection, and anyone that took that super trading and unbelievably aggressive. Unbelievably aggressive. I know when we talked about it, we had to go down to the 30 or the half-hour chart to actually get an entry on it. So there was your entry on the half-hour chart. Well done. So there it was. See that bar there? Just bring it over. So underneath that red bar, stop loss above it. Well done. Anyone that took that was a super, super trade. But the problem was that was absolutely against the trend. It was one of these ones that you had to ignore every bit of trend analysis and just go off this horizontal level. I'm expecting money. I'm expecting traders to short off that level. And that's exactly what happened. So we actually talked about this being a long off that small bar after that big red sell-off. Okay. Now, anyone that took that, you didn't get triggered in. Then it had a gap down, and then it started coming back up. So there was another entry long there. We now have an inside bar today, but for me, it still looks like there's more selling power than buying power at this present moment. So would this be the most successful trade in the world? Nope. Also, if I was taking that as a long, my take profit would have to be inside there. I would not be looking to take profit anywhere around here. It would have to be inside that high. Okay, everyone, it's been an absolute pleasure. Thank you very much for jumping in on the webinar. Hope you all have a lovely evening, and I will speak to you all tomorrow. Thank you. Bye-bye.